welcome to this explainer. We're going to be acting as your high-level business consultants today to demystify the complex compliance landscapes of four major global hubs. Expanding a business internationally is an incredibly exciting milestone, and thanks to globalization and digital commerce, it is definitely no longer just a game for massive multinational corporations. But without the right strategic playbook, navigating the web of foreign accounting and tax rules can quickly turn into an administrative nightmare that bleeds your capital dry before you even launch.
So let's dive right into this massive strategic question that startups, SMEs, and freelancers face in today's digital economy. Where in the world should your business grow next? It's not just about finding new customers, right? As you scale, the legal and financial ecosystem you choose is basically going to dictate your compliance risks, your overhead costs, and ultimately, your long-term growth opportunities.
Here is our playbook for today. First, global expansion, the contenders. Then, accounting and reporting rules, followed by the corporate tax breakdown, navigating global payroll systems, and finally, choosing your ideal location.
All right, let's jump straight into Section 1, Global Expansion, the Contenders.
The four top business destinations we're looking at are the United States, the United Kingdom, Australia, and Singapore. Now, why these four? Well, they all share a common law heritage, and they represent the premier launchpads for tech, services, and digital commerce in their respective hemispheres. And look, while all four are incredibly transparent, developed economies with highly mature financial ecosystems, they have wildly different frameworks for accounting, taxes, and payroll. And make no mistake, those differences are going to directly impact your bottom line and dictate your daily operational focus.
Moving right along to Section 2, Accounting and Reporting Rules.
How you actually keep your books builds the entire foundation of your international business operations. And there is a stark philosophical divide here. You can think of the U.S. system, U.S. GAAP, kind of like a locked book. It's a highly rigid, incredibly detailed, rules-based system developed by the Financial Accounting Standards Board. On the flip side, the UK, Australia, and Singapore utilize IFRS. That acts a bit more like, say, flowing parchment. Because IFRS is principles-based, your finance team gets way more flexibility in interpreting financial scenarios. And that often results in much less exhaustive, rigid compliance documentation than what you'd see out of the US system. Now, beyond just the standard rules, you also have distinct local watchdogs assessing your every move. Let's actually group these by the real burden of work they represent. The US SEC demands notoriously heavy, extensive reporting, especially if you're listed. Australia requires you to answer to both corporate and tax regulators, meaning dual filings to ASIC and the ATO. But if you look closely at Singapore and the UK, while you still report to their respective authorities, both jurisdictions intentionally offer simplified reporting exemptions. And honestly, those can save startups massive amounts of time and external accounting fees.
Okay, let's get into Section 3, the corporate tax breakdown. Because how you account for your money directly dictates how much the government actually takes. Looking at the numbers, Singapore acts as the streamlined express lane here, with a highly competitive 17% headline rate. On the totally opposite end of the spectrum, the US presents this complex, multi-layered labyrinth. You've got a 21% federal tax, plus state and local taxes that can range anywhere from 0 up to about 12%. So your total effective rate could easily hit 30%. Sitting right in the middle, we have the UK with a straightforward 25% current main rate, and Australia with a 30% standard company tax. Although it's worth noting that smaller Australian base rate entities can see that drop to 25%.
But here's the thing, you should never make a strategic choice based solely on that headline rate. I mean, a 25% tax rate means absolutely nothing if you qualify for massive localized deductions, right? For example, if you're building heavy IP and patented software, the UK's patent box is an absolute game changer. If you're a brand new entity, Singapore's famous startup tax exemption can literally drop your corporate tax to near 0 during your critical early years. Meanwhile, the US pushes innovation with massive R&D and clean energy credits, while Australia heavily draws in physical businesses with their instant asset write-off.
Which brings us to Section 4, Navigating Global Payroll Systems.
Moving on from corporate income tax, we really have to tackle the indirect taxes and local payroll requirements that trip up so many expanding founders. To cut right through the acronym soup, in the UK, Australia, and Singapore, the government handles indirect tax via a centralized value-added tax or goods and services tax. It's basically a single national rulebook. You just apply the UK's 20%, Australia's 10%, or Singapore's 9%, and you're largely covered. Operationally speaking, this unified approach is an absolute dream compared to the highly decentralized system in the United States.
Seriously, because the United States has no federal VAT,
You're dealing with a chaotic puzzle of state, county, and even city-level sales taxes. Imagine just selling a simple software subscription across state lines. A customer in Oregon triggers a 0% tax, but a customer in California might trigger a 7.25% or even higher rate depending on their specific zip code. So if you choose the U.S., outsourcing your payroll and indirect tax compliance to a specialized firm isn't just a luxury, it's mandatory for your operational survival.
Now, for actual employee payroll, the non-US contenders offer really centralized, predictable systems, but you definitely need to focus heavily on the employer's cash flow burden. In the UK, it's PAYE, which seamlessly handles income tax and national insurance. But in Australia, take careful note here. You use PAG withholding, sure, but you are legally on the hook for an additional 12% superannuation contribution on top of your employee's base salary. That is a massive hidden labor cost you absolutely must project for. Over in Singapore, they utilize the CPF. That's a highly streamlined contribution system funding housing and retirement, which beautifully keeps administrative overhead super low for founders.
All right, final stretch. Section 5, choosing your ideal location.
Now that we've broken down all those compliance hurdles, let's rapidly weigh the ultimate pros and cons of each destination. Let's summarize the United States first. It is an unparalleled giant. If you need maximum investor confidence, sheer economic scale, and access to the world's largest capital market, you go here. The trade-off? Well, you're going to pay a steep premium and agonizing state-by-state compliance, complex multi-layer taxation, and really heavy accounting costs.
Then we have the United Kingdom, which is basically your stable, well-regulated middle ground. It offers immense legal prestige, flexible IFRS-based reporting, and super straightforward tax administration. But you do have to accept the reality of a higher 25% corporate tax rate compared to those Asian hubs, and you have to meticulously adhere to their strict VAT registration and compliance rules.
Australia is a fantastic launchpad for the Asia-Pacific region. It boasts incredible regulatory transparency and phenomenally strong support for SMEs. However, your cash flow has got to be prepared to absorb much higher local labor costs, that strict 12% mandatory superannuation mandate we talked about, and a corporate tax rate that can actually hit 30% for larger entities.
And finally, Singapore. This is the premier business-friendly hub. You get a super low 17% tax rate, an extensive treaty network, and beautifully simple administration. The catch? You're operating in a much smaller domestic market. You're dealing with rising localized real estate and operating costs, and you'll be navigating increasingly strict visa and labor policies if your plan is to bring in foreign talent. So look, global expansion is never just about top-line revenue. It is entirely about the legal and operational realities of where you actually plant your flag. By understanding these critical differences in our explainer today, you've got the exact playbook you need. So as you plan your global footprint, ask yourself, is your priority tapping into limitless capital, streamlining your daily admin, or achieving ruthless tax efficiency? Because the ecosystem you choose right now will literally become your company's destiny. Which one are you going to conquer first?